Markets have been very difficult lately, but I don't think it's a real crash in the fundamentals. There's soft earnings growth, as Susan said before, and there's increased political risk, but I don't think the fundamentals are falling away, so I'm a buyer at this price.
Okay, so what are you concerned about then if you're not concerned about the fundamentals? Because some say on the downside, really, it's about protection against geopolitics, and you're seeing that with Ukraine.
That's right. Well, we have the Ukraine, and we also, this week, the U.S. announced they're selling destroyers to Japan, which, of course, is not a very positive Japan-China story. But I think the really issues are all in the banking area and the financial area. Two things. We saw today the new capital requirements come out for the large banks. They came out on a day when the market actually went up, but that's going to make it more difficult to loan. The problem is that there's growing evidence that the financial regulations may have killed part of the banking system in the U.S. You know, total loans fell from 1,600 to 1,200 billion loans to businesses during the financial crisis. Today they're back over their highs again. But if you break that down between big banks and little banks, the big banks are up a lot, and the little banks are down lower than they were at the bottom of the crisis. It's because the cost of compliance with the new regulations makes it essentially impossible for them to loan. The problem is they're the lenders to small businesses, which is where all jobs come from. Big banks loan to hedge funds and private equity firms. They're doing great. So we have a two-speed economy in the U.S., two-speed banking system. And unless we find a way to get those excess reserves the Fed has created through the banks into loans, we won't be able to get much growth.
But, John, we've already had the debate, for years now on FinReg, the onus of FinReg and Dodd-Frank and all that. People are looking forward to, wrapping up QE, getting to some normalcy in the rate environment so the banks will get out there and lend again because their spreads will be more advantageous for them. I mean, that is going to happen, isn't it?
Well, I actually think tougher credit or capital standards are a good idea. But the Fed to date has created $3 trillion of excess reserves. After the end of QE, they're still going to be sitting on the balance sheets of the Fed and the banks, which means that the banks have the ability to increase lending to deploy all of those reserves. To date, they haven't done that. If they do, then you have rising loans, rising spending, rising output, and ultimately rising interest rates and inflation. If the banking system is unable to put those reserves through into loans, then we wouldn't have any of those things. So I think that's the watershed question, is will the banking system come back to life? In history, there are no examples where it fails to come back to life, as you said. So I'm betting it is. That makes me think down the road inflation and rising interest rates are the things to watch out for. In the near term, you bet on the rising credit supplies to Wall Street.
Okay, so let me just get this straight, John. Are you a buyer or a seller of banks, I guess, near term, and then long term, what's your view?
I'm a buyer of the financial sector, which means especially leveraged finance. Private equity players, private equity bond players. The big names are the obvious ones that are in the market. It's, Blackstone, Carlyle, Apollo, Oaktree, those kinds of guys. Little banks is a different matter because it's a difficult set of regulations for a small bank to make money. So I only want to own the large ones at this point. But I really want to own the large banks' customers because they're the ones who are going to make the profits from the increase in loans.